Hey guys, this year we're going to look at how cutting company and capital gains taxes can improve our aggregate supply side conditions. Before we go look into that, we're going to define what company and capital gains taxes are. So company taxes are flat rate taxes, and they are paid on profit. So for example, if a firm earns or makes $1 million worth of profit, and at the moment the company tax is around 30%, then they would have to pay $300,000 to the government in tax. If a firm earns or makes $10 million in profit, they still pay 30%. So it's not like a progressive income tax system where as your income increases or as your profit increases, you have to pay a higher rate of tax. It doesn't work that way. It is a flat tax. A capital gains tax is a tax on appreciation of assets. So to put it simply, when your assets appreciate and you want to sell off that asset, then you have to pay tax. So paid on capital gains. So what this means is that if you bought land for $1 million and then you sell land for $2 million, then you've experienced a capital gain of $1 million. So you have to pay a rate of tax according to that $1 million increase in capital gain. So that's capital gain and company tax. Let's look at aggregate supply now. Aggregate supply is determined by two things. Firstly, we have our primary factors of production, and secondly, we have our secondary factors of production. Now, as we've talked about numerous times, our primary factors of production are land, labor, and capital. Our secondary factors of production is productivity. Now, as we can see, cutting company capital gains taxes would increase the after-tax profit of firms. The after-tax profit of firms would tend to increase because of this lower tax rate. So for this company tax rate, the government has indeed implemented a policy where they suggested that they will decrease the company tax rate from 30% to 29%. And although this may seem like a very small change, the company tax rate has in fact decreased from around 45% in the early 80s or in the early 90s to this current percentage now. So as we can see, this relates to business and investment spending. And so as a result, the factors that we are going to look at, or what cutting company capital gains tax would affect, are the capital, or the amount of capital for a firm, and also the productivity. Okay, so with after-tax profits, the firms can either do two things with them. They could pay to shareholders in the form of dividends, or they can keep it and invest it back into the firm, into the business. So as their after-tax profit increases, then of course they could give some of that profit to the shareholders, but they could also invest a proportion of that after-tax increase in after-tax profit into the business. And by investing that into the business, that would increase their capital and as a result increase productivity. So to look at a very simple example as to why capital increases productivity is this idea of technology. So in most years, technology improves in many different countries, especially in Australia, given we are living in a first world country. So every year we see that a new iPod comes out, a new iPhone, and all these little things, little improvements in technology. And it makes these financial, government, and even all these business systems a lot faster to use. And so by investing in this capital, so take a look at a business, for example, that works with machinery. If they invest in capital, they invest in machinery. Some of their old machinery may be outdated, and with new technology coming in every year, by investing in new machinery or up-to-date machinery with the most effective technology, then they would increase their productivity. And that's a very simple example as to why capital, especially capital with inbuilt improvements in technology, can improve the efficiency of production of firms. So as we know, capital has a direct relationship with productivity. And if these firms use their investment or invest wisely into capital, as well as say market research, plant equipment, and even other things that increase their productivity and aggregate supply of the firm, that would result in an increase in production rates or productivity. So this gives, by decreasing company and capital gains taxes, it incentivizes these firms, so it incentivizes firms to increase investment. So like any rational economist or investor, a decrease in tax would trigger an increase in investments. And as a result, with an increase in investments, we will see that aggregate supply in the economy would improve due to increases in capital technology, as well as increases in productivity as a result of capital and the utilization of more up-to-date and effective plant and equipment.